Welcome back to Investing Talk Podcast. Today, we're tackling a big question, one we hear quite a bit actually. Is Verizon Communications a good time to buy now? Before we jump in, if you're finding these discussions helpful, please do subscribe, maybe like this one, and leave us a comment. Your support, maybe even buying us a coffee, it really helps us bring you more insights like these. And, if there's a specific company you'd like us to look into, just let us know in the comments below. All right, let's get into Verizon. We've really dug into their Q2 2025 10Q filing. That's their, detailed quarterly report. Gives you a good look under the hood. We've also looked at recent market data, analyst reports, basically try to get the full picture for you. So let's start with the basics, the core business. How has Verizon actually been doing financially? What are the numbers from the first half of 2025 telling us?
Yeah, okay. So looking at the first 6 months of 2025, the numbers show a pretty steady picture. Total consolidated revenue was $68.3 billion. Now that's up just slightly from $67.6 billion in the same period last year, 2024.
Okay, so pretty modest growth then.
Exactly. Modest is the word.
Okay.
And their net income, that came in at $9 billion for that first half, which gives them a net profit margin of around 13%. Now, this fits right in with what management's been guiding towards. For the full year 2025, they're projecting basically flat to maybe low single-digit revenue growth. And their adjusted earnings per share, the guidance is between $5 and $5.10. So this modest growth, it's not really a surprise.
Right.
For a giant like Verizon, it's kind of what you'd expect. It's not chasing hyper-growth. It's about stability, consistent performance. Think more like a supertanker than a speedboat.
A super tanker, I like that. Steady, but takes time to turn. So with that modest growth, what about financial health? Any red flags or green lights on the balance sheet? We saw total debt around $146 billion as of June 30th. That sounds, well, huge.
It is a huge number, no doubt about it, $146 billion. But you have to put it in context, right? Their net debt to adjusted EBITDA ratio is sitting at about 2.7 times.
Okay, and what does that 2.7x actually mean in this industry?
Well, for a large telecom company, it's generally seen as manageable. It's actually consistent with the company's own targeted leverage range. Telecoms are super capital intensive, building out 5G, maintaining networks. It costs a fortune.
Sure, makes sense.
So high debt levels are kind of par for the course. What's more important is, can they handle it? And their cash flow suggests they can. Operating cash flow was $18.1 billion in the first half.
Wow, okay.
And free cash flow after capital expenditures was $8.9 billion.
Right.
So that shows they have this consistent ability to, fund their dividends, pay for network upgrades, and manage that debt.
So the debt's big, but the cash flow is there to support it.
Got it. How does Verizon stack up competitively then? They're still the biggest wireless carrier in the U.S. by subscribers, right?
Yeah.
Strong 5G, good brand. Absolutely. They are the leader by subscriber count, and that brand equity is significant. It's a real asset. But, while their market share is holding steady, the competition is fierce. You've got AT&T and T-Mobile constantly pushing with aggressive promotions, investing heavily in their own 5G networks.
So it's a constant battle.
It really is. It raises that question. How sustainable is their leadership position long term? They have to keep spending, keep innovating, just to stay ahead. It's not an easy position, even for the leader.
Okay, that paints a clear picture of the business itself. Now, the big question for investors is valuation. Is it priced right? What are the metrics telling us? As of late August, we saw a PE ratio around 8.9, price to sales at 1.6, price to book at 2.0.
Right, and this is where it gets interesting. Let's compare those to the broader large cap telecom industry averages. Typically, you see a PE around 13.2, price to sales, maybe 1.7, price to book 1.9.
Ah, so Verizon's PE is quite a bit lower than the average.
Exactly.
Yeah.
That 8.9 PE is a noticeable discount compared to its peers. And the market's not doing that randomly. It's reflecting, primarily that higher debt level we talked about, and also the expectation of slower growth compared to maybe some others.
So the market's already kind of baked those factors in.
Pretty much, yeah. The discount suggests the market sees the challenges and has adjusted the price accordingly. It's factored into the current share price.
What about other valuation methods? We saw that discounted cash flow, or DCF, models put the fair value somewhere in the $48 to $50 per share range.
Yes, that's the consensus from analysts running those models.
So with the stock trading in the, $43 to $45 range recently, does that suggest it might be modestly undervalued based on those models?
Yeah. Based on those consensus projections, it does suggest that. It implies the current price might be a little below what the models calculate as its intrinsic value. If, and it's an if, those future cash flow projections turn out to be accurate, then yes, there could be a potential opportunity there, a slight discount.
Okay. Let's shift from fundamentals and valuation to the technicals. What's the chart telling us? You mentioned it trading in that $43–45 range. Looks like it's building a base above support near $42.50 maybe, with resistance up around $46.57 por reals.
That's right. And if you look at the moving averages, the 50-day is hovering near $44, and the longer-term 200-day is up near $45.50.
What does that tell you?
It suggests a sort of sideways consolidation, maybe with a slightly bullish tilt, but nothing dramatic. It's like the stock is taking a breather, consolidating its position. And the RSI, the Relative Strength Index, is around 51. That's smack in the middle, really neutral momentum, no strong buying or selling pressure indicated there. Volatility has been moderate too.
So for chart watchers, it's basically waiting for a clearer signal.
And kind of quiet.
Yeah, pretty much. It's in a holding pattern, consolidating, maybe building energy, but no strong trend is apparent right now.
All right. What about news and sentiment? Anything recent moving the needle? We saw something about an S3ASR registration filing around August 29th. What's that about? Does that mean they're about to issue more stock? Good question. So that S3ASR, it's what's called a shelf registration. It basically gives Verizon the flexibility to issue various types of securities in the future if they choose to.
So it's not an announcement they are issuing stock now.
Exactly. It's not immediate dilution. Think of it as getting regulatory pre-approval just in case they need to raise capital down the road. It's quite common for large companies. More about maintaining flexibility.
Okay, that clarifies that. And what are the analysts saying overall? Still a hold.
Yeah, the consensus among the major analysts is still predominantly hold. The average price target is hovering around 48 AIs. There weren't any significant rating changes in August. Which, brings up an interesting point. Why hold if those DCF models suggest it's slightly undervalued?
Right.
It likely comes back to those factors we discussed. The modest growth outlook, the competitive pressures, the debt. Analysts are probably weighing the potential undervaluation against those ongoing risks and headwinds, leading to a neutral stance overall.
That makes sense. It's not just the numbers, it's the whole story. What about insiders? Are executives buying or selling? We saw some Form 4 filings, Vandana Venkatesh, Mary Lee Stillwell, acquiring phantom stock.
Yeah, those filings showed acquisitions, but they were related to phantom stock under deferred compensation plans.
So not open market buys.
Correct. It's part of their compensation package, not necessarily a signal that they believe the stock is a screaming buy at current prices. It's essentially neutral activity from a signaling perspective. No significant insider sales reported either, which is, I suppose, mildly positive, but overall, nothing really strong from insiders.
Okay. And general sentiment?
Social media chatter and general sentiment seem neutral to maybe slightly positive. The focus tends to be on Verizon's stability and, importantly, that dividend yield. People like that steady income.
Absolutely. So looking ahead now, what could actually move the stock? Any potential catalysts on the horizon? Near-term, I guess, Q3 earnings in late October?
Definitely. Earnings reports are always key checkpoints. Beyond that, in the shorter term, you might see incremental news about 5G network enhancements, maybe some announcements about new business or enterprise customer wins, small, steady progress type of news.
And longer term?
Longer term, the bigger potential catalysts revolve around finishing the next-gen network rollouts and, critically, finding more ways to monetize 5G. That means moving beyond just faster phone speeds.
Like what?
Things like advanced enterprise solutions, maybe fixed wireless access growth, Internet of the Things applications, stuff that really leverages the network capabilities. That's where potential new revenue streams could emerge. Also, keep an eye on broader sector stuff, any potential consolidation, future spectrum auctions, how the economy impacts business spending. Those could all play a role.
Okay, so potential upside there. But every investment has risks. What are the main roadblocks or challenges investors need to keep in mind with Verizon? That debt, $146 billion, keeps coming up.
It does, and it's probably the biggest one. That high debt load limits their financial flexibility, makes them more sensitive if interest rates were to rise significantly. Servicing that debt costs money that could otherwise be used for growth or returning more to shareholders.
Right.
Then there's the slow revenue growth environment and the constant pricing pressure from competitors. That's a persistent headwind. And just the nature of the business, it requires huge ongoing capital investment to keep the network cutting edge. Plus, you always have regulatory risks and the potential for technological disruption.
So quite a few things to watch on the risk side.
Definitely. The debt and the capital intensity, those are major long-term considerations. Plus, Broader market volatility, shifts in consumer spending, how quickly new technologies get adopted. All those external factors matter too.
Okay, so we've covered the business, the valuation, the charts, the news, catalyst risks. Pulling it all together, what's the overall investment thesis here? Is it a buy, sell, hold? What's the takeaway?
Right, weighing everything up, I'd give Verizon an overall rating of, say, 6.5 out of 10.
Okay, 6.5. Why that score?
Well, on the plus side, it offers that defensive quality, a solid dividend yield, which is attractive to income investors. And as we discussed, it does appear somewhat undervalued on certain metrics compared to peers. But balancing that out, the revenue growth is pretty sluggish, earnings visibility isn't super strong, and that high leverage is a real constraint. It limits upside potential and adds risk, especially if borrowing costs go up. And as we noted, insider activity is neutral.
So it sounds like maybe not the best choice for someone looking for rapid growth or quick gains. What kind of investor is it suited for? What's the time frame?
Exactly. I wouldn't recommend it for short-term traders looking for quick appreciation. The catalysts for a significant near-term upside seem limited. It's much better suited for a long-term investment horizon. For long-term holders, particularly those prioritizing income and stability, there's value here. You get that defensive profile, the steady cash flow, the reliable dividend, provided you accept the limited growth prospects and the ongoing need for them to manage that debt carefully. Ultimately, it really boils down to your personal investment goals and your tolerance for risk. Are you prioritizing stability and income over potentially higher, but maybe riskier growth?
That's the key question. And here's maybe a final thought for you to chew on. Given Verizon's defensive nature, that dividend focus, how does a stock like this fit into your overall portfolio? Think about its role compared to, say, a high-flying tech stock. One offers potential stability, the other aggressive growth potential. How do you balance those different roles, especially when the market feels unpredictable? Something to consider for your own strategy. Well, thank you for joining us for this look into Verizon Communications. We really hope peeling back the layers like this helps you make more informed investment decisions. We'll catch you on the next one.